welcome back to F.A.C.E, buddy.
Hey,
How are
Dale,
you?
thanks for having me. I'm doing great. Thanks for having me back on. It's
Yeah,
great to be here.
yeah, it's great to talk to you. Will you want to go cameras or it's up to you?
I
It's a
can do
great
whatever I
shot.
can do whatever you
All
prefer.
right, and I'm ready to ask you some questions about what you've been writing about. So, really, I don't need the chart, so I'll put my camera on and we
Okay,
could
perfect,
talk. Okay, we don't even need
perfect,
charts.
perfect. Let's see, where am I at?
So everyone, if you don't know Luke, I mean, his reputation precedes him wherever he goes, but he's the author of From the Forest to the Trees. And Luke, I've been reading some of your work, and why don't we start with something that is pretty interesting. You have a piece where you talk about where either the level of Dixie or the level of rates that you believe would cause the Fed to pivot. You want to talk about that?
Yeah, and they really sort of interplay with each other. The For me, ever since April 2020, when several Fed members, including Powell, mentioned or used the phrase "functioning," markets functioning. We're not trying to boost the markets; we're trying to keep them functioning properly. Our case has been that the Fed, and probably for longer than this is a practical matter, but the reality is 2020 was the first crisis where the Treasury market ended up crashing alongside stocks for a period of time.
Right. That was
And
unusual.
it was
That
very unusual.
60-40 mix did not work. They got hurt on both sides.
That's exactly right, and that's an Achilles heel of the U.S. financial system. And so, since April 2020, we've been talking about a shadow third mandate of the Fed being the Treasury market maintaining function. And for me, maintaining function is basically maintaining that classic 60-40 behavior, so that when stocks are down, bonds are up, and it can be vice versa. It doesn't have to be vice versa. But when stocks are down, Treasury bonds cannot be going down sharply as well. And so that is one trigger I watch for in and of itself. And interestingly, the higher the dollar goes, the higher Dixie goes through the calculation of FX hedging costs for U.S. dollar denominated bonds for foreigners. The higher the Dixie goes, the more expensive it gets to FX hedge dollar denominated bonds, and most importantly, Treasury bonds. And so there gets to be a feedback loop where the higher the dollar goes, the lower FX hedge Treasury yields end up going. And actually, right now they are not only negative for European investors, at least as of about 2 weeks ago, they were the most negative in history. They were also negative for Japanese investors at that point. And so the point here is that the higher the dollar goes, once FX hedge Treasury yields get negative, things start to get really interesting in Treasury markets, and really interesting for the Fed, because we saw this in 4Q18. FX hedge Treasury yields went negative. We saw stocks sell off at the fastest rate, I want to say, since since '08 in 4Q18, and Treasury yields just kept rising, and finally they did come in a bit, but ultimately they only came in a bit in the most pronounced way after the Fed was forced to back off of their tightening cycle. If you remember, at the end of 4Q18, the Fed came out and Treasury came out and said the banking system's fine, and then Treasury system. I watch those two very closely because there's an interplay with each other. The higher the dollar goes, the more stress there is in terms of reducing the foreign bid for Treasuries at a time where that stronger dollar is also having the impact that we've been having at FA.C.E, which is risk off and slower global economy, lower tax.
Could that have manifested, Luke, right here at 350 yields and 98 in the Dixie?
I think possibly. I mean, now, May, I'm looking at the chart here. May, you're seeing that foreign private demand for Treasuries was the strongest on record. So it looks like once it hit that, that's what am I looking at?
350 level on the 10-year?
Yeah, on the 10-year, it looks like there was a bid in May from the foreigners that brought that down. But then as you see it, it sort of went right back up. So they don't tell you when the foreign private sector was buying all those treasuries. Looking at that chart, if I had to guess, it would be in those red candles is when the foreigners said, okay, 3-2, we're going to load up here. But I think it was critical. You saw it went right back, right? There's this upward pressure on yield because of these factors that I'm talking about here. And they'll continue.
It would be pretty counterintuitive to expect the 10-year yield, if it takes out 274, 272, that's going to be pretty negative. It could take it down to 220 or so, Luke. Yep. That it would do that in front of a Fed meeting next week. What are your expectations?
I think they're going to do 75 basis points next week. I think it's the wrong thing to do. I think
you're a Fed chairman. What would you do? I'll vote for you, Luke.
If I was Fed chairman, if I couldn't resign, I would have resigned 12 months ago.
You didn't even want the job.
Especially if I was worth $100 million like Powell's reportedly worth. I wouldn't need this.
Yeah, why isn't he relaxing?
Seriously. But if that wasn't an option,
yeah,
I'd probably do the 75 real quick and be done with it. I think it's a mistake but I think it's the least mistake. And it buys him it buys him some time, which I think is probably more important. And the reason I say I think it's a mistake is I am hearing the economy took one big step down in May. I'm hearing in real time the economy is rolling over hard now. And while the Fed is busy looking at unemployment, which is a it's a lagging indicator. They were looking at employment last year while they were saying inflation was transitory. They were wrong. They're looking at unemployment now, saying we can do another 75 or 100. The economy's rolling hard. They're wrong. But that's why I say it does buy them some time and some room to then reverse themselves, which I think the 75 they do, if they do it next week, I think that'll be it.
Okay. Risk is acting that way. But this week we have another real important central bank in focus, the ECB, and you're talking about game theory in the EU, that they're repeating the same mistakes they did going into the Weimar Republic and hyperinflating. You want to tell us what that game theory is?
Yes,
that you speak about.
Absolutely. So it's something we've been writing about for the last 3 or 4 months, which is
Luke, I just have to stop you because I say it all the time. Who is we? Who is we?
Who is we? It's a force of habit. Me. It's me and my team. I do all the writing.
I know. Sometimes I think we have, a split personality.
Exactly, right?
Yeah. Yeah. Anyway, well, we is doing a good job. Go ahead, bro.
So what I've been writing for the last 3-4 months has been the European policymakers are running effectively the same economic playbook that the Weimar German government did in the aftermath of World War I, which is short version is after the end of World War I, the French seized Ruhr Valley coal stores as war reparations. The Germans weren't paying fast enough. French marched their army in and occupied the Ruhr Valley. Would not let that crisis. Energy crisis. Exactly. So so the Germans said, well, we don't have enough energy. Let's just print money. And when you start printing money to try to paper over an energy crisis, you end up with accelerating a runaway inflation problem. And if you just keep doing it, you will eventually end up with hyperinflation. I don't think the Europeans will hyperinflate because I hope they're smarter than that.
They have a memory.
They have a memory, the Germans in particular. But you're seeing symptoms of that, right? In the last 3-4 months, we're seeing German PPI at 30% or whatever it is. Now you are seeing this in the last week, this ECB periphery bond facility that they're intimating has no limits on it, where they are going to quote unquote buy periphery bonds so that they so that those yields better reflect economic fundamentals, which is an absolutely silly statement in my view, because they're the fact that they're widening are the economic fundamentals. They don't have enough energy. They are in an energy crisis. The creditworthiness of the periphery is deteriorating. So they are literally doing the same thing the German government did in the aftermath of World War I in the Weimar Republic, which is they have an energy crisis based on their going along with U.S. sanctions on Russia, and now they're printing money over to try to paper over, keep nominal economic growth going as if they don't have an energy crisis. And so until if they keep doing this, one of a couple things is going to happen in my view, and I think it's going to happen in the second half of this year. Either you're going to get a disorderly collapse in the euro, and I think we saw hints of that over the last couple of months, what that could look like.
Yeah, there's a chart.
Or you're going to get one of two, and interestingly, I think people are positioned for that option. There are two other options nobody's positioned for, in my view, or very few people, which is number one, the Fed comes in and starts buying euro debt. They start.
I was going to ask you about that,
which they can do.
Yeah, you said Bernanke set that precedent.
Yeah, he hasn't done it, but he let Bernanke in his famous deflation, making sure it doesn't happen here speech in December 2002 explicitly stated the Fed has the legal authority to buy foreign government debt. So that would just be effectively a currency intervention where Fed buying euro debt, or they could do this for Japan as well. So that's an option, I think, if the dollar gets strong enough, if the euro gets weak enough, in other words, that the Fed could do. Alternatively, I think if the U.S. refuses to do that for its allies, then I think we'll see ultimately realpolitik dictate that the Europeans turn back to Russia and say, okay, I'm sorry, we were wrong. Can we buy energy in euros, or can we buy energy in rubles? And you do whatever you want. We will sign a deal. And that, I think, will completely start to reorder the global geopolitical balance. I think that would have important implications for FX markets, risk markets, et cetera. And those are pretty broad ranging. But I think those two options are way more likely than people think, given that everybody's too strong. But consensus right now seems to be positioned for basically Armageddon in Europe.
Yes. Yeah, you can't find anyone bullish on Europe, and
included.
You know that what bailed them out for years was trade. And you would think with a weak euro, that would have been able to help. So you also talk about that, having a weak currency isn't as advantageous as it used to be if you have an energy crisis.
If you have an energy problem. I mean, you just saw there was a chart on Bloomberg the other day showed that the Germans actually ran a deficit for the first time since '91 because of energy. And that takes away the entire trade balance, right? So their current account surplus, largely generated by Germany, is now a deficit. Right. So now they're a twin deficit nation like the U.S., except they don't have the global reserve currency. And so that currency is going to go down and down and down until either it collapses or the
U.S. steps in with are we talking a Plaza Accord type of thing here? Global What do you think?
I think yes, and I think it's really important. You were showing that euro chart a little earlier.
Here it is.
That it bottomed on July 15th and started rising. Yeah. I did not realize this, and I'm as deep in the weeds on this stuff as anybody. Did you know that on July 15th there was a G20 finance ministers and central bank central bankers meeting in Bali that Yellen was at? I didn't know until someone pointed it out to me on Friday night. And so it's interesting. July 15th is Friday. The euro dollar's been straight up since then. And so my point being that I don't want to get crazy and play 5-minute macro. But you have a G20 that's not that well publicized, or certainly that sort of FinTwit and CNBC were not pumping all over as being a big deal. It was sort of on the QT, and since then the dollar's been the euro's been a one-way trade against the dollar, straight up. So maybe maybe there's an intervention that's begun. Same thing. Look at the yen, right?
Right.
Same. It's since yen's flat, so yen's down a little bit, flattened down a little bit, but risk assets are up since then.
It's not
Uh,
flat though, but longer term,
Longer term, oh no,
definitely.
yen's,
And
yeah,
and you talk about the problems in Japan. You want to
oh,
expound on it?
yeah, it's the same problem that Europe is having. Um, it's an energy crisis, and an energy
Okay.
crisis that, back in April we pointed out, it put them into a current account deficit position, and as soon as they go into a current account deficit, they're running twin deficits without the benefit of the global reserve currency. Now it's and basically starting right where that chart broke out to the upside, right, with the yen
Yeah.
deteriorating against the dollar. Kyle Bass's 2013 short the yen case finally came to life when they went into a current account deficit because of the energy crisis. And interestingly, because Japan owns $1.3 trillion in treasuries, $2.8 trillion in dollar assets in total on net, the 10-year treasury yield has been basically tied at the hip to the yen for much of this time. So the lower the yen goes, the higher the 10-year yield goes.
Yeah, they've been pretty married, except I would say that the yen kind of found a world of its own, like Rod Serlingville, compared to here's a 10-year. So they're going in different directions here. So, if we do break down here, that would probably also help if they could break the yen, strengthen it, that yields might fall.
And that's exactly what I think
That the
would be
playbook, bro?
discussed. That would be the playbook, right? And we've seen, you never believe anything until it's been officially denied. You had the Yellen saying a couple of weeks ago that they were not discussing supporting the Japanese government bond market with the Japanese government.
Oh,
So
methinks
there's,
thou protest too much.
yeah. So there is some level of knowledge about that, discussion about that. So let's see, because I agree. If you get the yen to weaken, you get yields down, you get the, the yen to strengthen, you get the dollar to weaken. The dollar to weaken gives
You get
everybody
oil
a
to break
breather.
down, Luke, under 94 this time. They saved it once. Could they save it again?
I think that might be the key linchpin, right? And one of the things that makes this whole environment much more complicated is I think the Fed might have already pivoted, given what we're seeing in some of the sequential readings, except for the fact that I think they know when they pivot, oil's going to go up, and if oil goes up, Putin wins. So sort of in their minds, to oversimplify. So I think they'd love to get oil down. I don't know that they're going to be able to get it down a whole lot more. I mean, down you're whatever, 120 to 98,
94 to 125, right in here.
Yeah, but it's going to be really
Technically
hard to
under 94, and this is the 50-week moving average here, could open the door for 80 or so.
Yeah, I agree with that. And the challenge, when I say they can't, of course they can. When I say they can't, I should caveat that for the reason I say that is the amount of economic demand destruction needed, in my view, to get oil down there will reverberate in tax receipts for the U.S. government, and as a result, the Treasury market much faster, and it'll effectively accelerate a balance of payments problem for the U.S. As well as for the U.S. basically, right? Because
okay,
yeah.
So let's wrap it with it. You talk about receipts, and I think you were talking about were you talking about just one state or the U.S. that and gross tax receipts are down 33%?
Yes, New York City last week came out
Okay.
and said that their estimated payments for June were down 31% year over year already, which was exactly what we've been looking for, which is obviously New York City is highly tied to the stock market and to asset prices, but the U.S. economy more broadly, on maybe only a slight lag to New York City, is tied to it. You just saw yesterday California housing sales down 21%. That's what happens when you take away NASDAQ collateral and you raise rates a little bit. And I guess you've raised rates more than a little bit, to be fair. But the point is you start taking housing sales down 21% on top of NASDAQ down 30%, California is going to be next in the tax receipt collapse banking machine. And the US government will be a month or two later, and your structural payments, entitlements, defense, treasury spending, they don't go down, they only go up. And so if your receipts go down,
right,
it's not going to take
it's
a very
squeeze.
big decline
Yeah.
to put those big three. Well, they're already more than receipts, but you start taking receipts down 10-20%, you're going to need to increase treasury issuance non-linearly in the third quarter at a time where Japan's selling, China's selling, Germany's selling, foreigners are, the foreign official sector is selling, and FX hedge treasury yields are now very, very negative. So you basically have to convince the global private sector to take, in Japan, -1% after FX hedging to own US treasuries on an annual basis. And, they might be more inclined to just buy JGBs yielding whatever, a quarter basis point. And so you start to see private sector selling of treasuries too globally. And that's why I say it'll start to reflect pretty quickly in a balance of payments problem for the US, because then you're going to be having US treasury yields go up in a recession.
Yeah. So, and it's basically because there's not enough demand to roll over the debt.
Yeah, it's ultimately the Fed and Treasury are withdrawing liquidity. US Treasury outlays in the third quarter are the biggest year-over-year decline, in the second quarter, biggest year-over-year decline in decades. It's coming off a very big high, so you have to put a little bit of an asterisk next to it. But look, federal government is 22% of GDP. 22% of GDP is down 20% year to date on a trailing 12-month basis. So that's a 4% headwind to GDP, and GDP fell, I think, 5% in the Great Financial Crisis on a full
So
year.
is the market betting the way risk has been acting, Luke, especially the more spec end Russell beginning to outperform even the S&P and NASDAQ? And that's kind of the trash, the Russell 2000 compared to, the old mega blue chips. Is risk saying that perhaps the market's going to think the Fed has it right for a while and risk continue to act okay?
I think it's starting to reflect how quickly the economy is weakening, and that this might be the last hike for the Fed.
Okay. And if you were Lagarde tomorrow, what would you do, a quarter or a half?
Probably a quarter, but they are really at the mercy of the US at this point, because your PPI is your PPI is 30% in Germany. Like does it really matter, quarter or a half? Like you should be raising them 20 points. But you can't, because you'll blow up the world. So
the Fed has to be the messiah, financial messiah here for central bankers.
I think so.
Okay, Luke, and tell your son he's got a great swing, and really appreciate you coming here and sharing your ideas, Luke. I learn every time I talk to you. I'm sure everyone.
Thank you very much.
And now I know that I'm not the only schizophrenic guy that says we were saying last week. Right, buddy?
It's a force of habit from working on the sell side for so long, right? It's never I, it's always we. So it's.
I know, and I also, just before you go, I just want to show, where people could find you, and it's the Twitter's at Luke Groman, but here's Luke's website, and his writings, I see him, and they're great, and he does videos, and really, if you like Luke's analysis of, seeing the forest from the trees, check him out at FFTT-LLC.com. Thank you, buddy.
All right, thanks for having me on, Dale. Take care, everybody.
Appreciate you, bro.
Have a great day.
All right, everyone, that's a wrap, and you could join the team in 20 minutes on the Morning Edge. Hope you enjoyed it. And we'll see everyone for tomorrow's session. Good hunting. Another one of my long goodbyes. Don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.